Hello everyone and welcome to this video in our financial accounting series. This video is going to focus on adjusting entries. Now, to understand the reason why we make adjusting entries, we have to do a quick comparison of the accrual basis of accounting and the cash basis of accounting. Now, the accrual basis of accounting, this is what we are going to be using and what we are going to be learning in the textbook and in the course. Under the accrual basis of accounting, we follow the revenue recognition and expense recognition requirements under U.S. GAAP, that is generally accepted accounting principles. And that simply says that we are going to recognize revenue when we earn it. That means when we provide the good or service to the customer, and we are going to recognize expenses when they are incurred, regardless of when the cash actually changes hands. So, under the accrual basis, we use the adjusting process to recognize revenues when they're earned and expenses when they're incurred in scenarios in which the cash flow may not fall in the same accounting period. Okay, this allows us to match expenses against the revenues they help to generate, which achieves the matching principle and gives us the most accurate possible picture of net income. Again, the accrual basis of accounting is required under U.S. GAAP. So for any publicly traded organizations with securities on the national stock exchanges like NASDAQ and the New York Stock Exchange, they have to follow generally accepted accounting principles. It also improves the comparability of financial statements. Now, the cash basis, as the name implies, you just record revenue when you receive cash from customers, and you record expenses when you pay for them. This is not permitted under U.S. GAAP because it is not in line with the matching principle. Now, you may say, well, why would anyone want to use the cash basis? It's only going to be really small companies. And for really small companies, it may be okay. You know, those that are not publicly traded, maybe they're just owned by one person, it might make sense for them to use the cash basis. But all big corporations, publicly traded, they have to use the accrual basis because they're required to adhere to U.S. GAAP. So now let's talk about these adjusting entries. Now, a lot of times when people hear the word adjusting entries, they think, oh, we're adjusting for something we did wrong. We're correcting a mistake or something along those lines. And that is simply not the case. Our adjusting entries are simply the adjustments that we are going to make to ensure that we are reporting our financial statements under the accrual basis. There are 4 types of adjusting entries. Okay, and we're going to look at examples of each of those. We have deferred expenses. And the debit and credit that you see listed there is simply the entry that you're going to make for the adjustment. Okay, a deferred expense. Some examples of these are things that we initially record as an asset, but then later move to expense as we use it. Okay, common examples are going to be things like prepaid expenses, office supplies, or a long-term asset for which we're going to record systematic depreciation on. Those are examples of deferred expenses. Deferred revenue happens when a customer pays us in advance, okay? As we've said, we recognize revenue when we earn it. So if a customer pays us in advance, we can't recognize the revenue. Instead, we report that as a liability called deferred revenue or unearned revenue, okay? So our adjustment is going to be to adjust that account. Accrued expenses happen basically when we have incurred an expense, but it hasn't been reported yet. Same thing is true with accrued revenue. We've earned revenue, but it hasn't been collected or reported yet. So let's look at some of these examples. All right, so our first example is going to be an example of a deferred expense. Okay, in this case, it's going to be a prepaid. Okay, so prepaid expenses are expenses that we have paid for in advance. So they have been recorded as an asset. So let's say for example, an insurance policy. All right, we might pay $1,200 up front for an insurance policy that's going to cover the next year. When we purchase the insurance policy, we would record a debit to prepaid insurance, which is an asset account. Okay, so remember assets, we're going to debit them to increase them. So debit to prepaid insurance, and we are going to credit cash. Again, remember, cash is also an asset account, so we credit cash to decrease it. So we pay for this insurance policy up front, debit prepaid insurance, credit cash. Now, this happened at the beginning of the month. We get down here to the end of the month, and guess what? That was a 12-month policy. So 1 month has expired. Okay, we have used up 1 month of that insurance. So what we need to do is take that 1 month's worth of insurance and move it out of the asset account and into expense because we've used it up. Okay. So we are going to debit insurance expense. We go over here to our debit credit chart, and we see that expenses, we debit them to increase them. So we are going to debit insurance expense, and we are going to credit prepaid insurance. Okay. Now, excuse me, I did not include a T account here on the screen, but I want you guys to look with me and see what happens to this prepaid insurance account. Okay. On January 1st, we had $1,200 in that account because we had $1,200 worth of prepaid insurance. Let's look at what the balance would be at the end of January. Once we record this $100 credit to the prepaid insurance account, the prepaid insurance account is no longer sitting at $1,200. It is sitting at $1,100, which makes perfect sense. Because at that point, we have $1,100 worth of prepaid insurance remaining. We have 11 months to go on that 12-month policy. So this entry actually does two fabulous things. One, it gets the expense in the right period. Okay, so we can match that against revenue. So that's a good thing. It also adjusts the asset account so that the asset account will now be carrying the correct balance at the end of the month and at the beginning of the next period. All right, let's look at another common deferred expense example. This time it's going to be supplies. Okay, so let's say that you're operating a small business. You may not use a whole lot of office supplies each month, but maybe it's less expensive to buy them in bulk. Okay, so let's say that you buy $2,000 worth of office supplies all at once. Okay, and you pay cash for them. Office supplies is an asset. Okay, so we go over here to our handy dandy chart, and what we find is asset, we need to debit to increase and credit to decrease. So we debit office supplies and we credit cash for $2,000 for that purchase of office supplies. Okay, now we get to the end of the month. Okay. We get to the end of the month and we need to account for the office supplies that have been used. Okay. Now, the most practical way to do this is probably to go into that office supply cabinet and see what's left. Okay. So let's say that you send your employee into the supply closet to do a little inventory. They come back and they say, we've got $1,500 worth of supplies left. Okay, this means that you must have used the other 500. Okay, if you started with 2,000, you've only got 1,500 left. You must have used up $500 worth of office supplies. So that's going to be the amount of the adjusting entry. We're going to debit office supplies expense for 500, credit office supplies. Again, this does two really great things. One, it gets that expense into the right accounting period, and two, it gets our office supplies account to the balance that it needs to be, okay? Because we had booked a debit of $2,000. when we book that credit of $500, that gives the account a net carrying balance of $1,500. And that's what we decided we should have based on the inventory done by the employee. All right, let's look at one more example of deferred expense. And this is going to be depreciation, okay? And one thing I want to point out about depreciation is in accounting, depreciation tends to have a different meaning and connotation than it does outside of accounting. Outside of accounting, we commonly hear people use the word depreciation to refer to a decline in value, okay? Something a car depreciates as soon as you drive it off the lot, that type of thing, okay? In accounting, when we use the term depreciation, we're not talking about a decline in value. Instead, what we're talking about is a cost allocation. It is when we take a long-term asset, meaning something that's going to be used across multiple accounting periods, and we attempt to spread that cost over the accounting periods that the asset's going to be used, thus matching the cost of the asset against the revenue that it is going to help to generate, okay? So let's assume that company A here buys some equipment for $60,000, okay? And let's say that they plan to use that equipment for 5 years, okay? Well, when they initially purchased the equipment, and I didn't include it here, that's my fault. I meant to say that they buy it on a long-term note, okay? That's why we're that's why we're crediting note payable instead of cash, okay? Because most companies aren't going to fork out $60,000 in cash, right? They're probably going to have some kind of note that they sign for that, all right? So we're going to record equipment, which is an asset, okay? So we're going to increase the asset account, $60,000. Note payable is a liability. We're also going to increase that, $60,000, okay? Now we get to the end of the month, and we need to record 1 month worth of depreciation. All right. Well, I kind of gave us some easy numbers here because if the equipment costs $60,000 and we're using it for 5 years, that's 60 months. So that means it's $1,000 a month. Okay. Now, one great thing about depreciation adjusting entries is they basically always look the same. The only thing that differs on a depreciation entry is this little thing that comes after depreciation expense. In this case, it's equipment because that's what we have here. And the same thing here after accumulated depreciation. But for a depreciation entry, the entry is always a debit to depreciation expense and a credit to accumulated depreciation. Okay? Now, let's talk about this for just a minute because this one could be a little bit confusing. Now, the depreciation expense probably makes sense, right? There's an expense, we're going to increase it, but what is this accumulated depreciation thing, okay? Accumulated depreciation is a very unique type of account. In accounting, we call them contra accounts, okay? A contra account is, think of it almost like a little partner account or a sister account, okay? This accumulated depreciation is going to be a sister account to equipment, and it's going to sit right under equipment on the balance sheet, okay? The difference between it and equipment is because it's a contra account, it is going to carry a negative balance, okay? So while equipment is going to sit there with a debit balance, accumulated depreciation equipment is going to sit there with a credit balance, okay? And so let's think about what happens every single month, month after month. We continue making this same entry month after month, okay? So this accumulated depreciation account, the credit continues to grow and grow and grow and grow, okay? So when we get to the end of, let's say that we get to the end of the first year and we've recorded a total of $12,000 in depreciation. The balance in this accumulated depreciation equipment account would be $12,000, and it would be a credit balance. Now, because it's a credit balance and it sits right on the balance sheet with equipment, here's what it allows us to do. It allows us to easily look at that equipment and the accumulated depreciation and compute a book value or carrying value for that asset at any given time. Okay, so for example, if equipment is sitting there with a debit balance of $60,000 and we have accumulated depreciation of say $12,000, then we know that the book value or carrying value, sometimes called the net carrying value, on that piece of equipment is $48,000. We can net the equipment debit against the accumulated depreciation credit that's sitting there on the balance sheet. Okay, so that's something a little bit unique about that account. All right, now we're going to move on. I think we've looked at several examples of deferred expenses, and that's actually probably the most complex example of the adjusting entries. The rest of them are pretty straightforward. So let's look at some examples of those. Deferred revenue. Okay, this is when someone pays us in advance. So let's say that company A receives $500 from a customer for work which will be performed at a later date. Okay, so let's say on January 17th, the customer gives us $500 in cash for work that we're going to come over and do in a week or two. Okay, we debit cash and we credit this account called unearned revenue. Unearned revenue is a liability. This is an example of when a liability represents goods or services that we owe to someone rather than cash. Okay, so we debit cash, credit unearned revenue, which is a liability. Okay, and then at the end of the month, let's say that we have done that work for the customer. Okay, we've done the $500 worth of work. We are then able to remove the liability. Okay, so remember we credited unearned revenue up here. Now we're going to debit unearned revenue, get rid of that liability, and we are going to credit revenue. And remember, revenue behaves just like equity, so we credit revenue to increase it. That is an example of an adjusting entry for deferred revenue. Accrued expenses. This is a good one because most companies are actually going to have lots and lots of different accrued expenses. It's pretty common to have expenses that you have incurred that haven't been paid yet at the end of a period. One example that's going to apply to pretty much every company out there is going to be wages or salaries. Okay. I would say almost all companies are not going to, pay their employees cash on a daily basis. Okay, that's just not how it's done, right? Employees, they work for a week or two, and then, they're paid on some regular payroll cycle. So what this means is, at the end of any given fiscal month, there's probably going to be some days that the employees have worked that they haven't been paid for yet, because those days fall into, a payroll cycle that's going to happen in the future. Okay, so let's say, for example, on January 31st, Company A determines that employees have worked 3 days for which they have not been paid. Okay, and we are going to assume that that wage expense comes to $1,000 a day. Just for simplicity's sake, we're going to assume that that the employees make $1,000 a day, and they've worked for 3 days that they haven't been paid for yet. We would debit wage expense and credit wages payable for the $3,000. Expense goes up, liability goes up. Accrued revenue. Accrued revenue. This is when we have done work that has not been reported or collected, okay? So let's say that on January 29th, we perform services for $350. We send the customer an invoice and they're going to pay us next month, okay? We need to report the revenue because we have earned it, okay? The revenue has been earned. Remember, matching principle and revenue recognition, we report the revenue when we earn it. So we're going to debit accounts receivable $350. That customer owes us $350. Accounts receivable is an asset. The debit is going to increase it, and we are going to credit service revenue. Revenue account doing the credit is going to increase that account as well. So that's kind of a quick summary of the different types of adjusting entries that you can expect to see. Once our adjustments are made, we can create an adjusted trial balance. And what you see here is a worksheet, okay? And what the worksheet allows you to do is it allows you to take your unadjusted trial balance, enter the adjustments that you make, and these are just some examples here. They don't relate to the examples that we just did, but this is just kind of an example. For example, in their entry A, it looks like they debited insurance expense for $100, and then they came up here and they credited prepaid insurance for $100. You can kind of look at the letters and it matches up the entries, but it allows you to enter your adjustments here, and then you can easily recompute the adjusted balance for each of these accounts, and you can see that in every scenario, the total debits and total credits should be equal. All right, and after all those adjusting entries are made, we have that adjusted trial balance, and from that adjusted trial balance, we can prepare the financial statements. We always start with the income statement. Okay, revenues minus expenses gives us net income. We then move to the statement of retained earnings. Beginning retained earnings plus net income minus any dividends or withdrawals by the owners equals ending retained earnings. Once we have ending retained earnings, we move over and we can prepare the balance sheet. We've got our assets, liabilities. Now we have our correct ending retained earnings balance, and our balance sheet should be in balance. So I hope that you've enjoyed this lecture. Thank you for watching.